Hey everybody, Dave Hagan here. Today we're going to talk about the Wealthy Barber. Not a person, but a book. That's today on the Financial Wellness Podcast.
Welcome to the Financial Wellness Podcast, Dave's weekly message to keep you on your path to the financial success. Here is your host, financial problem solver and talk show host, Dave Hagan.
Well, hello everybody, and welcome to this week's edition of the Financial Wellness Podcast, or the TFWP as we like to call it. Not with me today is Mr. Brian Reed. He's taking a well-deserved vacation, and he'll be back in a week or so. We're coming to you from beautiful downtown Van Nuys. For those of you that are not in the California area, that's kind of near Hollywood. Today, I want to talk about not a person, but a book called The Wealthy Barber. And let me tell you how I came to get to know about this book. This book is hanging around my house. And it's on the coffee table and it's on the bookshelf. And I'm going, yeah, whatever, The Wealthy Barber. Don't need to know about that. It actually belonged to my wife. And she tells me that it's required reading for a certified financial planner certification at UCLA. So now I'm thinking, well, now it's probably a high-end book with a funny title. Sounds maybe interesting. So I read it over a recent vacation. I read it a couple afternoons. Not very difficult reading, very nice conversational reading. And after a couple of days, I pretty much had it digested. I liked this book. Let me tell you a little bit about it. It was originally published in 1989. And it's been on the bestseller list on and off for years. It's sold millions of copies. It's maybe 190 pages, so it's not a real long read. In fact, I was looking around the house for it just the other day as I was preparing some of my notes for the show, and I had forgotten how thin the book actually is. It reads more like a novel, and it's got financial advice kind of woven in, and that's kind of nice. So many financial advice or personal finance books are just kind of dry, and this is a story. It's a story about a barber who's been very successful in his personal financial affairs, and he's got a couple of his customers who come in and start asking him about what he's doing because it's starting to get around town that he's wealthy. And over a series of, 4, 5, 6, 7, 8 meetings with the barber when they come in to get their haircut, he gives them some advice and then a little assignment. And he provides them with common sense and wit about how to organize their financial affairs, their personal financial affairs. And they have different issues going on in their life. One's a single person, another person's a married person, there's one person that spends a lot, there's another person that doesn't have any real estate, et cetera, et cetera, et cetera. But by the time you go through this book, you have a pretty good rudimentary understanding of the basics of personal finance. It's an easy read. It's not a long read. You can get it on Amazon for about $10. The author isn't paying me to review his book or pitch it today. I just like it. And who wouldn't spend $10 and a couple of evenings to read a novel full of good financial advice? It doesn't get any better than that. Check it out. All right, so let me tell you a little bit about the author because I've come to know him a little bit. You know me, I'm always thinking when I see something, either it's on the internet or even a book, I go, who wrote it and why did they write it? I think that's one of the most necessary tools and areas of inquiry that we need to follow up on in this internet age. In fact, I think it's such a critical skill that they should be teaching that in all of our schools. So this book was written by David Chilton, and he's a Canadian citizen. He wrote the book and when he was 25. So what did I say? Back in 1989, he was 25, and he wrote the book, sat down and put it together. And he later wrote cookbooks about how to eat and cook healthy. Does that sound familiar? We talked about that on some of the podcasts. So we're all kind of in similar veins. I'm starting to like this guy a lot. And we've put some people up here on the podcast in our pantheon, like Warren Buffett. We've spent a couple of podcasts talking about some of the wit and wisdom of Warren Buffett. And I think that it may be that David Chilton will now become part of that pantheon of independent, high-level, common sense thinkers in the area of personal finance. Now, I'm not saying that we need to be all in and follow him, like a complete follower. I don't think that we need to completely adopt all of the philosophies of the people in our pantheon. Rather, I think that we can pick and choose some of the different things that they say or some of their various philosophies, evaluate them, and if they work for us, make those part of our own personal philosophy. So what's Mr. Chilton's philosophy? Well, you really need to read the book. I know, again, it sounds like a pitch, and it's not, but you really need to read the book, and you really need to enjoy the read, and maybe a couple of notes, not more than a couple of sentences, perhaps, on a chapter. But he talks about savings and life insurance and investing in retirement and home ownership and all of these things. But the key takeaway in my mind, the biggest highlight, is his recommendation that you take 10% of your pay every month, put it in a long-term savings account, and watch it provide you with financial wealth over the long term. And I think the key, at least for me, and we all react to different philosophies or thought patterns differently, but the key for me is that he tells you to pay yourself off the topper first. He says, put it away, take 10%, don't look at it, put it in some kind of a fund, and we'll talk about that in just a little bit, but pay yourself off the top. And then all the other things that you do during the month kind of fall into place. Now, he calls it the 10% solution. So I'm going to talk about it and reference it as a 10% solution. As we're talking about personal finance, most of the time we talk about putting together a spending plan each month, not a budget. Remember, budget's a bad word at TFWP. And we talk about creating a circumstance that yields money at the bottom each month. And that's the money that we want to invest. It's the money that we want to have left over. But to create that leftover, it means that we have to limit ourselves with all of the other expenditures. And it's not always easy to have some money left over for investing every month because stuff happens. Cars break down, medical bills arise, repairs need to be made, etc., etc. And it's very hard to consistently have that money left over. And so his approach is different. His approach is take it off the top, put it away. That's your long-term savings. That's going to be your personal wealth. And then the other money that you have left over, which is the bulk of it, frankly, it doesn't matter so much what you do with it. You want to spend a lot on a car, spend a lot on a car. If you want to spend a lot on a house, do that. If you want to spend a lot on going out to restaurants, doesn't matter because you've already created and taken out that money off the top. And I think that's a great way of looking at it. In fact, Chilton says in his book that, when you take this 10% off the top and you move it across to a different account automatically each month, you hardly even notice it. In fact, your lifestyle adapts to what's left over and you don't even feel it. In fact, this is kind of the thought behind employee withholding tax. The money comes out before you get before you get your check, or even some of the thought behind this new California savings plan, Cal Savers, the money comes out of your check. And if you're not getting the money, or if you're not seeing that money in a physical way, it's not part of your net paycheck, it's not really affecting your lifestyle because you adapt your lifestyle hopefully adapt your lifestyle based upon the amount of that net check. Now, he doesn't even say in his book whether he's talking about gross or net, because in this world, the difference between gross and net can be pretty significant, right? Gross is what you earn, and net is really what you're taking home, what your paycheck is. And from his perspective, it doesn't matter so much. In fact, I saw him in an interview and he said, hey, I tried to be specifically a little ambiguous about that in the book because I really didn't want to get people too much hung up on specific numbers. Now, of course, it's better if you take 10% of your gross. That's more powerful. And you're still not going to miss that. But the important thing is you set it up so that 10% comes off the top every month for your long-term personal wealth. And he says if you do this, your financial future will be more than likely very secure. Now, he gives some examples in his book. Here's his example. $200 a month for 30 years at 15%. Now, 15% return on investment is probably a little high in terms of expectations. But for his example, $200 a month, which is nothing for 30 years, which isn't someone's full lifespan in terms of work. It's not their full lifetime capacity. At 15%, yields $1.4 million. And most of us are going to work for more than 30 years, and most of us can afford to put in $200 a month and not even miss it. In fact, I think a lot of us could put in more than that and not even miss it. So if you're looking at the long term, if the money's coming out off the top, if the money's coming out without you knowing about it, it can be extremely powerful. Now, I wanted to look at a slightly different parameter. So here's my example. If you make only $40,000 per year your entire life, which you won't, you're going to make more than that. For sure, you're going to make more than that a good number of years in your life. But let's say you only make $40,000 per year and you put 15% of that, 15% of the gross, in a savings for 40 years at 7%. Now, 7% is a lower rate of return than his example, and 15% is a little higher deduction out of your check than his example, and I'm talking about 40 years. But 15% of $40,000 for 40 years at 7%, which you can for sure get if you're investing long term, if you're playing long ball. What do you think that's going to yield you? $1.1 million. Now, there could be some tax that's due on that money if you didn't put it into a proper type of account, like if you didn't put it into a retirement account like a Roth IRA. That money is going to have to be taxed, depending upon the gain in the fund and et cetera, et cetera, et cetera. But the point is that if you take the money off the top, do it automatically every month, enjoy the miracle of compounding interest over many years, that you'll have a very large sum of money down the line. And I think the takeaway for me, the magic of this book, The Wealthy Barber, is exactly that. Now, Chilton recommends that you put money in something with a long-term view, something almost boring. Does that sound familiar? How many times have we talked about that at TFWP? Invest in something that's boring. Invest in something that's not sexy or glamorous to talk about at a party. He talks about shopping different mutual funds. And of course, mutual funds back in the 80s and 90s were a much bigger thing. In fact, they were an emerging thing almost at that point. And he says, you just pick one that seems to have a good rate of return, do a little bit of shopping, go to one of these brokerage houses, whether it's Schwab or Ameritrade or T. Rowe Price or E-Trade or whatever. They all have their own proprietary mutual funds, and put the money in there. And yeah, you keep an eye on it a little bit, but the money comes out every month and you put that into stock. He also mentions putting it into ETFs, which is an initials for exchange traded fund. And basically these are more mechanical funds. There's not somebody investing the money per se. These are more mechanical funds that index or follow certain industries or countries or, even the Dow Jones. It's a mechanical, statistical, mathematical investment, which, if you're investing along the lines of the Dow Jones over the whole bunch of last years, 40 years, the return is going to be, I think it's like 11 or 12%. Not bad. not bad. Here's an aside for you. I was recently a guest on somebody's show, and they wanted me there to talk about personal finance. And so before the show began, everyone was asking me for, investment advice or their quick tip or their one thing or, some kind of comment about that. And my response was, first of all, I'm not here to provide investment advice because I'm not really the person to talk to about that. I'm not going to talk about specific issues or investments. I'm not really qualified to do that. And they were pretty crestfallen. And then they told me what their 5 or 6 stocks that they had in their fund, and this was their particular magical mix. And they said, "What do you think about that?" And I said, "Well, I'm not going to give you specific advice, but it sounds like you're diversified, and it sounds like you've got, companies. You own stock in companies that are doing pretty well, or say they seem pretty well, situated in the market. They're rather successful. I guess that sounds all right, but again, I'm not going to comment on any specific issue." And I said, if you invest with the long view, if you invest consistently, if you invest in something that's diversified, and I said mutual funds or ETFs, I think you're going to be okay. It's not sexy, it's not inviting, but it's the advice that I would provide more or less, and it's also the advice that Chilton is providing in his book. So think about that. Not sexy, not glamorous. Pick a mutual fund, something that's not that exciting. Choose it, stay with it, kind of keep an eye on it, and it'll just grow over time. Now, the author admits that this advice in his book is not that complicated. And you know what? It's not. It's common sense stuff. As you're reading the book, you go, yeah, that makes so much sense. That's so basic. Yeah, I could have thought of that. But a lot of times we don't because, the ball game's coming up on TV, or we're meeting friends, or we got stuck in traffic, or we need to go out and, mow the lawn or meet a friend, whatever. We get caught up in our day-to-day stuff and we don't look at the big, long picture. But like we've said so many times on the podcast, it's kind of ironic that it's the simple things that are many times the most powerful things. They're like intrinsic truths in life. And something long-term with a reasonable rate of return is going to provide you something very, very powerful in your life in the long run. So there you have it. The Wealthy Barber by David Chilton. That's my review. That's my take. I talk about this on the air quite a bit. Brian and I are always going back and forth on a lot of these things. But it was still a very informative and enjoyable read. I like the novel format of it. It takes a little while to get caught up in the story, but once you do, you just keep going through it. And it's a very enjoyable novel. I mean, he really calls it a novel more than anything else. It's entertaining, it's powerful, it's simple. And the biggest takeaway, again, is that you should take 10% out of your check or out of your bank automatically every month off the top and pay yourself, and then invest it in something with a very long-term view and become a very wealthy person. Check it out. And that's a wrap. This is Dave Hagan, and you're listening to the Financial Wellness Podcast.
You've been listening to the Financial Wellness Podcast, Dave's weekly message to keep you on your path to financial success. If you have a question that you would like Dave to answer on the podcast, go to thefinancialwellnesspodcast.com. You can leave an audio message with one click of a button, or type your message into the question box. Either way, it's sent right to Dave's phone. As an additional bonus, each month, Dave will randomly draw from the submitted questions and pick the winner of a free 1-hour personal conversation with Dave to help you achieve your financial goals. Don't forget to subscribe to the podcast so you receive the new episode notifications. Let's listen in now as Dave answers some emails.
All right, I'm going to read the emails here today because Brian is still on vacation. This is a email from Brian, not the Brian, but a listener named Brian, and it says, "Hey, Dave, I just graduated from a 4-year school and I moved home. It's not the best situation, but hey, the price is right. Now my parents are charging me rent. What gives? Is this uncool or what? Well, Brian, I don't know. It seems to me that your parents owe you, food and housing and education, at least through high school and maybe through, your undergrad degree. But maybe they're doing you a favor when you move home. I mean, I remember when a lot of my classmates moved home after a 4-year college education. Some of them were just told, hey, do whatever you want for the next year. You can just sit here and sit in the sun or lay by the pool or whatever. Well, I had to get out. I had to make some money. But maybe they're doing you a favor, not by letting you just coast. Maybe they're doing you a favor by charging you some rent. You want to really be able to understand and feel what it's like to get out there and get a paycheck or earn some money, and how much of it's going to go towards rent, because it's a sizable amount for almost everybody. Housing is our largest monthly expense. So if they're not charging you any money and you're getting a check, assuming that you're working, it gives you a false impression in terms of how much money you have floating around each month at that income level. So maybe they're doing you a favor. Another thought, maybe your folks have a mortgage on the property. Maybe they have expenses that they need to meet, and maybe having you move home and be around and buy food for you and all these other things, maybe that expense is something that they can't absorb anymore. Forget the should or shouldn't. Maybe they can't absorb that anymore, and you need to contribute. So I think that's something certainly to think about too. Now, what would be totally cool is if they obviously don't need that money, they could take it and put it into some account and give it to you at some point someday. But that's kind of up to them. That's at their discretion. So I think they're kind of doing you a favor. It's a little abrupt. It's a little, it's coming at you kind of quick. But I think it's going to be a good lesson for you. It's going to be a good experience for you. And I think in the long term, it's going to give you a real sense of, what you got to make to where you got to live, even if it's totally uncool to be paying rent for your own room. That's my take, Brian. I don't know if that's what you wanted to hear, but that's my 2 cents. So I think that's a wrap for this week. We've got the book review that we did on The Wealthy Barber by David Chilton. We've got an interesting little email, and I think that's enough to think about this week. Tune in next week. We're going to talk about the latest skirmish in the cable TV wars with something called Lowcast. This is Dave Hagan, and you've been listening to the Financial Wellness Podcast.
You've been listening to the Financial Wellness Podcast, Dave's weekly message to keep you on your path to financial success. If you have a question that you would like Dave to answer on the podcast, go to thefinancialwellnesspodcast.com. You can leave an audio message with one click of a button, or type your message into the question box. Either way, it's sent right to Dave's phone. Remember, Dave will randomly draw from the submitted questions and pick the winner of a free 1-hour personal conversation with Dave to help you achieve your financial goals. Don't forget to subscribe to the podcast so you receive the new episode notifications, or share the podcast via the app with your family and friends. This is your announcer, Nick Appel, wishing you every financial success.